The Nasdaq is currently closed, but the last reported closing price for SoFi Technologies, Inc. was $24.91 on Friday, November 21, 2025, with an intraday range of $23.52 to $25.48, reflecting a significant drop of over 6% on Friday's session alone. Now, the common expectation following a big move like that, especially one to the downside, is for the stock to be battered by profit-taking and technical breakdowns. However, the unexpected twist here lies in the sheer volume and the unusual pattern of institutional activity leading into that decline, which suggests the selling pressure was not simply retail panic, but a sophisticated, concentrated effort that has quietly rotated capital, and that is what should hold your attention. We are not just looking at a price drop, but a fascinating study in expectation versus market reality. And the story of SoFi is much more intricate than a single-day sell-off implies. The general market belief about SoFi remains largely positive, centered on its execution of the digital finance super app strategy and the major milestone of achieving quarterly profitability, which has propelled the stock higher over the past year. The expectation is that with its bank charter, the company is now a legitimate, diversified financial institution capable of consistent, high-growth revenue, moving well beyond its roots in student loan refinancing. This narrative of a fintech ascending to stability is what fueled the run-up to its 52-week high of $32.73. The reality, though, is that the price action we saw late last week, characterized by elevated volume that was over 1.2 times its 30-day average, reveals a fundamental tension at the $25 to $26 support level. This is the battleground where the growth story bulls meet the valuation skeptics, and the latter group is currently putting immense pressure on the stock. We have seen significant insider selling reported in the days leading up to the dip, with the chief risk officer and other executives selling shares, which, while often scheduled, adds a layer of concern about management's conviction at current pricing levels. Large institutional funds like JP Chase and BlackRock have been aggressively adding to their positions in the recent quarter, accumulating tens of millions of shares, showing a clear long-term belief in the business model. Yet the price still dropped sharply, suggesting that even as some institutions are building large passive positions, others are actively trading around those core holdings, or that the market is beginning to factor in a more difficult macro environment for lending. SoFi's core business model is a comprehensive digital-first financial services platform that offers lending products, primarily student loans, personal loans, and home loans, alongside its financial services segment, which includes SoFi Money, checking and savings accounts, SoFi Invest, brokerage, and the proprietary technology platform Galileo. The Galileo platform is the sleeper asset here, providing the backbone and API infrastructure for other fintechs and non-financial companies to offer their own digital banking services. This is crucial because it provides high-margin, capital-light, recurring fee revenue that diversifies the company away from the cyclical nature of its lending business. Older reports highlight how the lifting of the student loan payment moratorium was a major tailwind for the student loan segment, which is a return to a core competency. But the true evolution is the success of cross-selling. The company has repeatedly stated that its long-term profitability hinges on members utilizing multiple products, creating a sticky, high lifetime value relationship. The market is constantly weighing the explosive growth in member and product count against the cost of acquiring those members and the overall quality of the loan book in a high interest rate environment. The growth expectation is for SoFi to continue its streak of increasing its member base, which last quarter added nearly 1 million new accounts to reach 12.6 million members. Now, let's look at the crucial element of short-selling awareness, which is non-negotiable for a stock with such a passionate retail following. SoFi is under undeniable short-seller pressure, but it is not currently in extreme short-squeeze territory. The official Nasdaq reported short interest is substantial, sitting at approximately 110 million shares, representing a short interest as a percentage of the float of around 9.3%. This is a high number, but what is more interesting is the days to cover metric, which is a very low 1.52 days. This low number suggests that even with a high absolute number of shorted shares, the average daily trading volume is so massive, around 76 million shares, that the short sellers could cover their positions relatively quickly without causing a catastrophic price spike. The current borrow fee rate is also notably low, sitting around 0.25% per annum, which is a critical piece of actionable insight for retail investors. A low borrow rate signals that the supply of shares available to short is plentiful and the perceived risk by institutional lenders is minimal. If the borrow rate were spiking above 10 or 20%, that would be a clear sign of scarcity and an imminent risk of a squeeze. The lack of such a spike suggests that while major hedge funds like Susquehanna International Group have reported large put positions in past filings, their underlying thesis is centered on valuation compression or macro headwinds, not a company-specific imminent failure. Actionable insight for the retail investor here is to monitor the short interest data for the mid-December reporting period. Look for a rising days to cover ratio, which would indicate that volume is drying up while the short position remains large. That is the classic squeeze setup. Currently, what we see is coordinated off-exchange short volume, with a recent ratio of non-exchange short volume to total volume frequently above 30%. This suggests a high degree of sophisticated short-selling activity occurring in dark pools. The short thesis, which is pushed by outfits like the anonymous research reports that circulate in forums and some cautious analysts, centers on the idea that SoFi's valuation has become unmoored from its net tangible book value, its loan book is sensitive to a deteriorating consumer credit environment, and that its path to sustainable generally accepted accounting principles, or GAAP profitability, is heavily reliant on the student loan refinancing boom that may not materialize as anticipated. Retail investors need to recognize that not every short is a coordinated manipulation. Many are smart money bets on overvaluation. The response is not to blindly buy, but to understand the opposing argument. In the future outlook, the key catalysts are centered on two main pillars. The first is maintaining the momentum of its non-lending businesses, particularly Galileo and the core SoFi money product, to drive high-margin fee revenue and stabilize earnings. The second, and perhaps the biggest risk, is the Federal Reserve's rate path. High interest rates are a double-edged sword for SoFi. They allow the company to earn higher net interest margins on its loan portfolio, but they simultaneously pressure borrower demand for new loans and increase the risk of default. The market has an expectation that SoFi's growth rate will remain high, but the reality is that its future growth will likely slow somewhat as the law of large numbers takes hold. The company is now a $30 billion market cap institution, and maintaining a 50% year-over-year revenue increase becomes mathematically more challenging with each passing quarter. The major opportunity lies in the eventual shift in the macro environment. When the Fed signals a definitive end to rate hikes and perhaps a move towards rate cuts, the entire lending and financial services sector will adjust. For SoFi, a future of lower rates could reignite the student loan refinancing engine, which was historically its bread and butter. The risk is that the company must prove it can manage its loan book quality during an economic slowdown. We have seen some recent chatter on retail forums about the insider sales being a major red flag, with some calling for increased transparency on how the sales were prearranged. The most informed investors understand that Form 144 filings and preset trading plans exist, but the timing is always a psychological blow to sentiment. Comment below how many shares of SoFi Technologies Inc. you currently hold, or if you are waiting for a dip below the $22 mark to start a position, so we can gauge the true retail sentiment. This stock's narrative is a perfect example of expectation versus reality. The expectation is a simple story of a successful fintech building a fortress balance sheet fueled by continuous member growth. The reality is far more complex. It is a battleground stock with high institutional accumulation offset by persistent short pressure, a low borrow fee suggesting no immediate short squeeze risk, and a business model that is a delicate balancing act between high-growth fintech operations and the capital-intensive, cyclical nature of a chartered bank. To navigate this, investors need to focus less on the daily noise and more on the quarterly core trends, member growth, product adoption metrics like cross-selling rates, and most importantly, the Galileo platform's performance. The final, lasting insight is that the Friday sell-off, while sharp, was a volume-driven event that retested a key support level, not a catastrophic break. The coming week will be a true test of whether the bullish accumulation from major players like JP Chase will hold the line against the continued professional selling pressure that sees the company as fundamentally overvalued given the macroeconomic risks. What is your take on the rising short interest? Smart money or manipulation? The key signals to watch next